You didn't sign anything. No document, no contract, no ceremony. And yet, every single day, a deal governs your life. It decides how expensive your future will be, how fragile your job is, how nervous your government becomes, and how powerful your bank really is. You were never invited into the room, but you're bound by the agreement. This is the invisible deal between banks, states, and you. And right now, it matters more than it has in decades, because this deal was designed for a world that no longer exists. Let's start with something simple. Most people think money flows like this. You work, you earn, you save, banks store your money, governments collect taxes and spend them. That story feels reasonable. It's also almost entirely wrong. In reality, money doesn't sit quietly in banks. Governments don't simply spend what they collect, and your savings are not as separate from the system as you think. The truth is less comforting. Modern economies don't run on money. They run on promises, and promises, by definition, only work when everyone believes someone else will keep theirs. This invisible deal emerged after the last time the global system nearly tore itself apart. The Great Depression wasn't just an economic disaster. It was a legitimacy crisis. Banks collapsed, governments looked helpless, people stopped trusting both. So a new arrangement slowly formed. Banks would become the engine of money creation, governments would become the guarantors of stability, and citizens would become the shock absorbers, not officially, not openly, but structurally. Here's how it works. When you deposit money in a bank, the bank doesn't store it, it lends it. In fact, banks lend far more money than they actually have. They create new money every time they issue a loan, your mortgage, a business loan, a government bond purchase. New money enters the system not through printing presses, but through debt. Now here's where the deal gets interesting. Banks are private institutions. They exist to make profit. They take risks because risk is how profit is generated. But the system cannot allow banks to fail freely, because if banks fail, the promises collapse, deposits vanish, credit freezes, businesses shut down, jobs disappear. So governments step in, not because they love banks, but because they fear the alternative. This is where the invisible deal locks into place. Banks take risk, governments absorb catastrophe, citizens pay the long-term cost. Again, not explicitly, but mathematically. Think about 2008. Banks made reckless bets. The system cracked. Governments stepped in with trillions. Where did that money come from? Debt, public debt, debt that didn't exist before the rescue. Debt that now sits on government balance sheets, debt that must be serviced, and servicing debt doesn't look dramatic, it looks boring. Lower public spending, higher taxes, inflation that quietly erodes purchasing power. No emergency press conferences, just years of subtle pressure. This is the first uncomfortable reveal. Bailouts don't end crises, they redistribute them over time. Now let's go deeper. Governments themselves are deeply entangled in this deal. Modern states don't fund themselves primarily through taxes. They fund themselves through borrowing. They issue bonds. Banks buy them. Central banks support the market. This creates a loop. Banks need safe assets. Governments need buyers for debt. Central banks ensure the system doesn't seize up. Everyone depends on everyone else, which sounds stable until you realize it isn't, because stability now depends on confidence. As long as markets believe governments can repay, as long as people believe banks are solvent, as long as inflation feels manageable, the moment belief wobbles, everything tightens. Credit becomes expensive, governments panic, banks retreat, and once again, citizens absorb the shock. Here's the irony. You are told this system exists to protect you: deposit insurance, central bank independence, financial regulation, and to be fair, it does prevent total collapse, but it also quietly locks you into the role of guarantor, not legally, economically. Your wages, your savings, your cost of living, they adjust to keep the system upright. Let's talk about inflation for a moment. Inflation isn't just prices rising. It's a transfer mechanism. When governments and banks expand the money supply to stabilize crises, purchasing power doesn't disappear evenly. It erodes quietly, unevenly, often invisibly. Wages lag, assets inflate, debt becomes easier to manage. If you own assets, inflation can feel like growth. If you live on wages, it feels like suffocation. This is not an accident. It's an incentive structure. Debt-heavy systems prefer moderate inflation. It makes old promises easier to keep. This brings us to the second uncomfortable truth. The system is not optimized for fairness. It's optimized for continuity. Keeping the machine running matters more than who benefits. Public narratives rarely say this out loud. You're told banks are heavily regulated. You're told governments act in the public interest. You're told crises are unpredictable shocks. But the incentives are visible if you look. Banks are rewarded for expansion. Governments are rewarded for short-term stability. Long-term costs are deferred to future budgets, future voters, future you. There's a quiet absurdity here. The system constantly warns you about debt. Personal debt is framed as risky, irresponsible, dangerous. But the entire structure is built on exponential borrowing at the top, private caution, public leverage. Now zoom out. What happens when this deal runs for decades? Debt piles up, interest costs grow, governments become sensitive to market moods, policy stops being about long-term RM planning. It becomes about maintaining confidence. Interest rates can't rise too fast, spending can't fall too sharply, banks can't be allowed to fail. The room to maneuver shrinks, and the system becomes more fragile, not less. This is why every crisis now feels existential. Because each rescue makes the next one harder. Each intervention raises the stakes. This is also why political tension rises. Citizens feel pressure, but can't locate the source. They're told growth is strong, markets are up, yet life feels tighter. That disconnect breeds suspicion. Who is this system really for? The answer is uncomfortable. It's for itself. The invisible deal prioritizes survival of the structure over satisfaction of participants. Banks need governments. Governments need banks. And both rely on the public's ability to absorb adjustment, quietly. Now, here's the part most discussions avoid. This deal is not collapsing tomorrow. It doesn't end in a single dramatic explosion. It erodes, through normalization of crisis, through permanent emergency measures, through policies that once felt extraordinary becoming routine. What used to be unthinkable becomes necessary. What used to be temporary becomes permanent. And the public adapts. That adaptability is the system's greatest strength and its greatest risk, because systems that rely on silent consent eventually test its limits. So where does that leave you? You can't opt out entirely. You can't vote it away easy. Lie. And you can't ignore it without consequence. Understanding the deal doesn't give you control, but it does give you clarity. Clarity about why crises repeat, why promises sound hollow, why stability feels increasingly fragile. The invisible deal between banks, states, and you was never meant to be visible, because, once seen clearly, it raises a question no one in power likes to answer. If the system depends on you absorbing the cost, at what point do you get a seat at the table? Or does the deal only work as long as you never ask?